Good morning. Today is Thursday, January 16th, 2025. A belated Happy New Year to all of our viewers. I'm Joe Terril, president of Terril and Company, independent wealth managers headquartered in St. Louis, Missouri, with approximately $850 million in discretionary assets under management. I'm joined today with Russ Phillips and Bill Newbold of our investment committee, and this is an update. Apologize a little bit that this update is a couple weeks late, but we intentionally wanted to see some of the economic news that has come out on inflation, on retail sales, on industrial production, before we did our video, and in addition to it, wanted to begin to see earnings reports from banks and a few of the industrial companies before we did the video. So there was a little bit of reason why we're later than normal with this video. So with that said, let's talk about Terril and Company's outlook. And we have been very correct in saying for the last 2 years or more, no recession, forget about the yield curve inverting, dictating we're going to have a recession. Nope, we've been very much in the camp that the economy is strong and going to remain strong. We've seen nothing to change that view. This morning's economic figures show, when you strip everything away, that people are working, they're making money, they're still getting pay raises, and they're spending money. This is keeping the economy strong, and we think that part of it will continue for the United States. With that said, because of the strength of the economy, we've also been very correct about the fact that interest rates are not getting ready to plunge back down to 2%. Bill will give us some figures in a few moments. And then in addition to that, the federal budget deficits that's got to be financed. We can go on with a number of things about what could or could not go wrong for investment markets. But let me stop for a few moments and turn over to the very capable Russ Phillips to talk about stocks in particular. And Russ, you and I talked before we started filming. I know you want to talk about the volatility, and I'd like for you to, just so our viewers can understand how volatile this is. And I said I'm going to stop. I'm going to throw one more thing in. Overall, we are better sellers of stocks than we are buyers for the moment. But Russ, thank you, and let's chat a little bit about stocks and equities in particular.
Thank you, Joe. I think I agree 100%. We are better sellers than buyers of stocks at this point. I think there's two key words that our team is looking at, and volatility is one of those. And you've really seen that. 700 points up yesterday. We started really in after the election, kind of in December. We kind of had a movement back to the Magnificent Seven and away from those 490 or 93 stocks we've been talking about. And now 1 month later, we're back. And I think financial earnings were just the first of what we will see to be an interesting earnings season. If you look at the bank earnings that were reported, J.P. Morgan, Citigroup, a name we own and we've done very well with, U.S. Bank, it seems like anybody that was an investment bank or had trading operations did very well. This morning, I mentioned U.S. Bank and PNC, not as big investment bank type operations. Those earnings, a little bit tougher. Not that the earnings were bad, they were not. It was more the look forward about loan growth and different things. So more kind of the guidance looking ahead. And that really plays into what we're looking for in terms of the stocks that we're going to own moving forward in 2025. They're going to have some version of a catalyst, and they're going to have good earnings. That's kind of how I'm viewing it to kind of start things out in 2025. So volatility, earnings, that's what good earnings is what we're looking for. We're expecting volatility.
Russ, thank you. Bill, let me turn to you now just to talk about the interest rate structure and maybe just one or two reasons why Terril and Company believes interest rates are not getting ready to plunge back down to 2%, et cetera.
Sure. Thanks, Joe. When Joe mentions that we're of the thesis that interest rates are not going to go back down, the economy is just too strong. The data points that we're seeing, whether it was retail sales today, GDP estimates are still very solid. And we've had quite a bit of run higher in interest rates over the last year or so. If you go back to when the Fed first began cutting interest rates, the 10-year Treasury bond was yielding 3.65%. It's now at 4.62%. And on our last broadcast on December 11th, the 10-year Treasury was at 4.24%. Again, it's now at 4.62. So even in the midst of the Fed cutting interest rates, the 10-year Treasury yield has risen. And that's really just a function of the economy being too strong. And so when Russ and Joe mentioned that we're going to be managing for risk and better sellers, we still feel like the market is pricing in 2 interest rate cuts in 2025, and most of those rate cuts now have been pushed out to the summer Fed meetings. Again, we're not so sure that the Fed will be cutting interest rates. So again, as Russ mentioned, we'll be looking for value names. We'll be looking for stocks with specific catalysts, whether that's a turn in operations or a new management team. We like companies with share buybacks and free cash flow. So regardless of how this scenario plays out, our process will remain very consistent. But again, we're of the thesis that interest rates are going to remain high at these current levels in here.
Thanks, Bill. Let me sum up just a few things here in the few moments that we have left. One of them is the fact that in fixed income, we are keeping our maturities and durations as short as we possibly can. This has proven to be the correct part of the fixed income market for the last 3 years or more. We own floating rate paper, we own reset paper, things that will benefit if interest rates stay higher or even move higher from here. They would not have a negative effect unless we're wrong and interest rates go down 2% or more, which we don't believe is getting ready to happen. The other scenario that I just wanted to chat a little bit about is when you look at the overall investment landscape, you see professional people very cautious. We were talking about the fact that Warren Buffett has never had so much cash and so low of an equity position as what he does right now. This weekend's Barron's and their year-end review and their outlook for this year, the professional people are very cautious, worried about things. It was interesting to me because that's how we have felt for some time, but the public is the opposite. When you hear the public all talking about stocks and what they have to own and all the aggressive things, as much as what we've seen, it makes you cautious. Over a period of time, the public ends up being wrong, and we're a little worried that we might be in another scenario like that. So we appreciate everybody turning in today, and we'll be back probably by month end with another update. Thank you for joining us today.